Alright, so now let's go ahead and work through this problem number 5. So what this problem is asking us to do is giving us some details on the size of the fund, how much assets it has under management, and some of its transactions. So it sold 400 billion worth of stock and purchased 500 million during the year. So we have to calculate the turnover ratio. So what does the turnover ratio calculate? It basically gives an estimate of how much of its existing portfolio has the fund changed. Changed meaning it has bought something or sold something and then replaced it with something else. Not simply buying something, because the fund can also simply buy assets if it has an inflow of new money. So what this is telling us is, of its existing portfolio of 2.2 billion, the fund sold $400 million worth of stock, and then so you're selling $400 million worth, so you're going to get $400 million. It's going to use that to buy alternative stocks. But then it also purchased an additional 100 million because the total purchases are 500 million. So where did that additional 100 million come from? So that is due to new inflows. Okay. So of its existing portfolio, it sold $400 million worth of stock and then purchased 400 million of new stock, different stock, and then it had additional purchases of 100 million. So its portfolio turnover is going to be based upon how much of its portfolio did it change. So it changed $400 million worth of its portfolio of a total of 2.2 billion. So 400 million over 2.2 billion, that's 18.2%. All right, let's go to the next problem. So this is about the expenses of the mutual fund, and this is important for us to understand because as we've seen before, higher expenses means lower returns to the investor, right? So it's important for us to get a handle on it. So let us suppose it's the same fund as in the earlier example, all right, the same new fund. It has average daily assets of 2.2 billion, total billion, sorry, not bullion, billion. The total expense ratio was 1.1%, and the management fee was 0.7%. So these are all percentages of assets under management. So if you are charging asset management fee of 0.7%, it's 0.7% of 2.2 billion, which is 15.4 million. Now, your total expenses were 1.1%, of which the management fee, asset management fee, was 0.7%. So the balance 0.4% is due to other expenses, okay, administrative expenses. So that is 0.4% of 2.2 billion or 8.8 million. Okay, so you can see these are not small sums, okay, they're pretty large. Now let us suppose that you are an investor and you purchase 100 shares of this fund at a price of $20 per share at the beginning of the year. And then you also paid a front-end load of 4%. Now the securities are increasing in value by 12%. That means that's basically what the fund manager is earning. But then they're incurring a cost of 1.2% as expenses. So now the question is, if your holding period is 1 year, what is the investor's rate of return even though the assets have earned 12%? So let's go ahead and work through this. So we have invested $20,000 in the fund, but it comes with a 4% load. So this 20,000 is after the 4% load. That means the investor must have actually spent 20,833. So how do I get this? It is basically 20,000 divided by 96% or 0.96. That will give me 20,833.33. How can I check? I can check that take 4% of this investment amount, that's my load, that is 833.33. So out of this investment, so much goes towards the load. So the balance is basically what is invested in the mutual fund, which is 20,000. Now the increase in value is 12%. So 12% of 20,000 is 2,400. Keep in mind this 833 basically goes to the broker as a front-end load. So this is actually not invested in the fund. So this is not earning you any return. Okay. So this is just a out-of-pocket cost that you have to incur to buy into this fund. Okay. So you're going to earn the return only on the actual invested amount, which is 20,000. So you're getting 12% of that, which is 2,400. Expenses 1.2% of 20,000, that is 240. So the ending value is So you invested 20,000, it earned 2,400, but then it had to pay out $240 as expenses. So the ending value is 22,160. So what is the return to the investor? Not the fund, the investor. So the investor is ending up with a value of 22,160, but they have actually invested 2,833.33. So the return is only 6.37%, even though the fund actually earned 12%. Why is that? The reason is you have to pay this big load. So that is reducing the amount of your actual investment. So let's go ahead and work through another example of a mutual fund, or comparing a couple of mutual funds, and make sure that we understand how the investor's rate of return is going to vary with all the different costs and things they charge. So this 12B1 fee, this is basically the marketing fee that they charge, because the mutual fund has to market the fund to investors. They will put out ads, they'll buy printouts, and they will mail it to you, things like that, right? So let us say this 12B1 fee is 1%, and it has an expense ratio of 0.75%. Now a different fund, it charges a front-end load of 2%, but it has no marketing fee and it has a lower expense ratio of 0.25%. Now we are going to assume that the assets are going to return 6% every year. Okay. So let us see how we can compare these two funds. Okay. So let us say you're assuming $1,000 investment in both of them. The first fund, which is the loaded fund, has no loads, so you're going to have the entire $1,000 invested. The economy fund, on the other hand, has a 2% load, so 2% of this, or $20, goes as a load, so you're only going to invest $980. Now what is going to be the net return for the investor? They're going to get whatever the gross return, which is 6%, minus all of these expenses. So they're going to have to pay out on the loaded fund, they have to pay out 1% as a 12B1 fee and 0.75% as expenses. So the total is 1.75%. So the assets are earning 6%. You are incurring a cost of 1.75%. So the net return for the investor is only 4.25%. How about in the economy fund? So the assets are going to return 6%, but there is no 12B1 fee, and then the expense ratio is 0.25%. So the investor return is 5.75%. So 6% minus a quarter percent minus 0. So that is 5.75%. So now I can calculate the future values easily. So future value at time 1. So $1,000 times 1.0425. That's that. Future value at time 3. 1,000 times 1 plus 4.25% raised to the power 3, because it's 3 years. And for 10 years, you'll simply raise it to the power 10. Similarly, for the economy fund, the only thing that's going to change is the return. So for the first year, it's going to be 980 times 1.0575. So that is so much. 3 years, 980 times 1.0575 raised to the power 3, which is that. And for the 10 years, you'll simply raise it to the power 10. Okay. So what you can see is, if you are investing for the short term, maybe the loaded fund is better. Okay, because you're going to end up with more money. But if you have a longer horizon, then the economy fund is better. Why does that happen? Because when you're looking at a very short horizon, you're going to pay this load of 2%, which essentially acts like a cost. Okay, but because this load is only paid once, if you have a long horizon, you can amortize that fixed cost over multiple years. Okay, so then that cost becomes very small, but then the savings in lower expense ratio is more significant. So then you end up with much greater values. Okay, so this is basically how you can compare investments with different types of fees, different loads, different expense ratios, and so on, depending on what your investment horizon is going to be. So hopefully these examples have given you a good idea as to how mutual funds work, what are the different costs involved, how to take into account all the different fees, the costs, how to calculate the NAV, how to calculate the investor return, and so on. Okay, so please make sure you work through all these problems.